Dear family of seekers and students of wisdom, respected viewers who have chosen this moment to pursue something deeper than mere survival, I welcome you with gratitude and humility. You are here because something inside you knows that wealth is fragile, that everything you've built can disappear in an instant. That security, as we've been taught to understand it, is an illusion. And you're right to sense this. But what if I told you there's a way to build wealth that doesn't just survive chaos, but actually grows stronger because of it? There exists a rare quality that separates those who build dynasties from those who watch fortunes crumble. It's not about avoiding disaster. It's about becoming the kind of person, the kind of investor, who transforms disaster into advantage. Most people spend their lives trying to protect what they have, but the truly wealthy, they've discovered how to profit from uncertainty itself. Let me take you back to a conversation I had in the winter of 2008. The financial world was collapsing. Lehman Brothers had fallen. Banks were failing. Retirement accounts were evaporating. Everywhere you looked, people were losing everything they'd spent lifetimes building. The fear was so thick you could taste it. I met a man named David at a coffee shop in Manhattan. He wasn't there by choice. His office building had been evacuated due to some emergency. He was in his late 40s, wearing an expensive suit that suddenly looked too heavy on his shoulders. His hands shook slightly as he held his phone, watching his portfolio dissolve in real time. I did everything right, he told me, his voice hollow. I diversified, I bought blue chips, I had a financial advisor, I followed all the rules. And now I'm watching 30 years of savings disappear. I asked him a question that seemed cruel at the moment. David, did you build your wealth to survive, or did you build it to be fragile? He looked at me like I was speaking another language. What's the difference? And that question, dear friends, that question contains everything, because most people build wealth the way you'd build a house of cards. Carefully, precisely, with everything balanced just right, and it works, until the slightest wind blows. Then it all comes down, and they're left wondering what went wrong, why their careful planning failed, why the rules they followed didn't protect them. But there's another way, a way that's been known by the truly wealthy for centuries, but rarely spoken about. A way that doesn't just prepare for chaos, it feeds on it. It's called anti-fragility. And once you understand it, you'll never look at money, business, or life the same way again. Anti-fragility isn't strength. It isn't resilience. It isn't even survival. Those concepts are about withstanding shocks, about taking hits and staying standing. Anti-fragility is something entirely different. It's about becoming stronger, richer, more capable specifically because of shocks. It's about building systems that don't just survive volatility, they profit from it. Think about your body for a moment. When you lift weights, you're actually damaging your muscle fibers, creating tiny tears, causing stress. And what happens? Your body doesn't just repair the damage, it overcompensates. It builds the muscles back stronger than before. That's anti-fragility. The stress didn't weaken you. It made you more capable. Now imagine applying that principle to your wealth, to your investments, to your entire financial life. Instead of trying to build a portfolio that never goes down, what if you built one that actually benefits from going down? Instead of trying to predict the future and position yourself perfectly, what if you positioned yourself to profit regardless of what the future brings? This sounds impossible to most people, because they've been taught that wealth comes from being right, from making correct predictions, from avoiding mistakes. But that's fragile thinking. That's the thinking that creates millionaires who become broke. That's the thinking that built David's portfolio, the one that was evaporating while we sat in that coffee shop. Let me tell you about a woman named Sarah. I met her years before the 2008 crisis at a small investment conference. She wasn't wealthy by conventional standards. She worked as a nurse, made a decent living, nothing extraordinary. But she had a philosophy that fascinated me. I assume I'm going to be wrong, she told me, about everything, about which stocks will go up, about what the economy will do, about timing. So I don't build my portfolio based on being right. I build it based on surviving being wrong. Most people would dismiss this as pessimism, as defeatism. But Sarah understood something profound. She understood that overconfidence is the most expensive mistake an investor can make, that the feeling of certainty is usually the moment right before catastrophe. So she built her wealth differently. She kept a substantial portion of her savings in cash, not because she was scared, but because she knew opportunities would come. She invested in businesses with little to no debt, not because debt is always bad, but because she knew stress would come. She owned assets that performed differently in different environments, not because she was hedging, but because she didn't know which environment would arrive. And here's what happened in 2008. While David and millions like him watched their carefully constructed portfolios crumble, while they felt paralyzed by fear and uncertainty, Sarah went shopping. She bought wonderful businesses at prices that hadn't been seen in decades. She deployed that cash she'd been wasting by keeping it on the sidelines. She took advantage of the very chaos that was destroying others. By 2010, her net worth had doubled. By 2015, it had tripled. Not from genius, not from lucky timing, from anti-fragility, from building a financial life that didn't need things to go right to succeed. That actually benefited when things went wrong. This is the strategy, beloved listeners. This is the one approach that keeps you rich forever, not by avoiding storms, but by having an umbrella business when it rains and an ice cream stand when it's sunny. Not by predicting the future, but by being positioned to profit from multiple possible futures. But here's where it gets difficult. Here's where most people fail even when they understand the concept intellectually. Because building anti-fragile wealth requires you to do things that feel wrong, that feel inefficient, that feel like you're leaving money on the table. Keeping cash when markets are rising feels stupid. Owning bonds when stocks are soaring feels wasteful. Having insurance when everything's fine feels expensive. Not using leverage when your neighbors are getting rich with it feels like cowardice. This is the psychological trap that destroys anti-fragility before it can work. I remember talking to a young investor named Marcus during the bull market of the late 2010s. He'd read about anti-fragility. He understood the concepts, but he couldn't implement them. Everyone around me is making 20, 30, 40% returns, he said, frustrated. They're fully invested. They're using margin. They're in growth stocks and crypto and all these things that are exploding. And I'm sitting here with conservative positions in cash and I'm making 8%. I feel like an idiot. I feel like I'm missing the entire party. You are missing the party, I told him honestly. The question is, do you want to be at every party, or do you want to still be wealthy when the parties end? He didn't like that answer. Most people don't, because it forces you to confront something uncomfortable. You cannot maximize returns and maximize anti-fragility at the same time. You have to choose. Do you want the highest possible gains when things go right? Or do you want gains when things go right and gains when things go wrong? The fragile investor chooses the first option. They optimize for the good times. They leverage up. They concentrate their bets. They take on risk to maximize returns. And when times are good, they look brilliant. They're the ones with the stories, the big wins, the impressive numbers. But they're one bad break away from catastrophe, one unexpected event from ruin. They've built tall towers on weak foundations. The anti-fragile investor chooses the second option. They accept lower returns during good times in exchange for positive returns during bad times. They keep optionality. They maintain flexibility. They position themselves to take advantage of chaos. And they sleep well at night, not because nothing can go wrong, but because they're prepared to profit when things do go wrong. Think about insurance. You pay premiums every year, and most years you get nothing back. You're losing money. The house doesn't burn down. The car doesn't crash. You don't get sick. All that money seems wasted, but you pay it anyway. Why? Because you understand that the small predictable loss is worth it to avoid the large catastrophic one. Anti-fragile investing is similar. You pay small costs during calm times. The opportunity cost of holding cash, the drag of conservative positions, the expense of diversification. These feel like losses when markets are soaring. But they're not losses, they're premiums. You're paying for the right to profit when chaos comes. And chaos always comes, always. I watched this play out in my own life during the dot-com bubble. Everyone I knew was getting rich in internet stocks. Companies with no profits, no viable business models, nothing but a website and a story. They were worth billions. And I was sitting there investing in boring businesses. Insurance companies, banks, consumer goods manufacturers. Things that actually made money, People called me old-fashioned, out of touch. They said I didn't understand the new economy, that the old rules didn't apply anymore, that I was missing the greatest wealth creation opportunity in history. And you know what? They were right about one thing. I was missing it. I wasn't participating in the mania. I wasn't getting those triple-digit returns. But I also wasn't positioned fragilely. I wasn't leveraged. I wasn't concentrated in one sector. I wasn't dependent on the bubble continuing to inflate. So when it burst, when trillions of dollars evaporated, when those internet millionaires became broke almost overnight, I was still standing, still solvent, still able to invest. And here's the beautiful thing about anti-fragility. The same events that destroy the fragile create opportunities for the anti-fragile. When everyone else was forced to sell, I was able to buy. When panic dominated, I had the emotional and financial capacity to be rational. When prices collapsed, I had the cash to take advantage. This is the pattern that repeats throughout history. The fragile build massive fortunes during good times and lose them during bad times. The anti-fragile build moderate fortunes during good times and massive fortunes during bad times. Over a lifetime, over multiple cycles, the anti-fragile always win, not because they're smarter, but because they're still playing when everyone else has been eliminated from the game. Let me tell you about a decision I made early in my career that seemed crazy to everyone around me. I refused to use meaningful leverage. Not because I was scared, not because I didn't understand it, but because I understood something more important. Leverage is the enemy of anti-fragility. When you borrow to invest, you're making a bet that things will go as expected, that markets will rise, that your investments will perform, that you'll be able to service the debt. You're adding fragility to your system, because now you don't just need to be right about the investment. You need to be right about the timing. You need things to work out before the debt comes due. You need the market to cooperate with your schedule. I had friends who used leverage brilliantly. They turned hundreds of thousands into millions. They looked like geniuses. Until 2008, until their loans got called, until they were forced to sell wonderful businesses at terrible prices because they couldn't service their debt. They had been right about the investments, but they'd been fragile in their structure. And fragility eventually destroys everything it touches. So I stayed unleveraged. I stayed liquid. I stayed flexible. And people thought I was being overcautious. They thought I was leaving money on the table. They thought I didn't understand how to maximize returns. But I understood something they didn't. I was building a machine that would still be running when their machines broke down. This is the essence of anti-fragility in wealth building, dear friends. It's not about avoiding risk. It's about structuring your risks so that you can survive being wrong, so that you have resources when opportunities appear, so that you're positioned to profit from volatility rather than be destroyed by it. But let me be clear about something. Anti-fragility is not the same as playing it safe. It's not about hiding in treasury bonds and cash forever. It's not about being so conservative that you never participate in growth. That's not anti-fragile. That's just fragile in a different way. Because if you never take intelligent risks, you're fragile to inflation, to opportunity cost, to time itself. True anti-fragility is about intelligent structure, about having enough safety to survive anything, and enough exposure to benefit from good outcomes. It's about portfolio construction that doesn't depend on any single scenario playing out. It's about building wealth that works in multiple possible futures. I think about this like building an investment portfolio the way you design a sailing ship. You need enough ballast to keep you stable in storms, but you also need enough sail to catch wind when it comes. Too much ballast and you're too heavy to move. Too much sail and you capsize in rough waters. The art is finding the balance, the proportion that lets you survive the storms and capture the winds. Most investors build all sail and no ballast. They're fully invested, fully leveraged, fully exposed to their best case scenario. And when the weather's good, they fly. They're the fastest ships on the water. But when the storm comes, they capsize, they sink, and they wonder why their speed didn't save them. The anti-fragile investor builds differently. Plenty of ballast, enough to stay upright in any storm, but also plenty of sail, enough to move quickly when opportunities arrive. It's not the fastest ship in good weather, but it's the only ship still sailing after the storm passes. And that is the strategy that keeps you rich forever. I met a man in his 70s a few years ago. He'd built and lost 3 fortunes in his life, made millions in real estate in the 80s, lost it all in the crash of the early 90s, made millions in technology stocks in the late 90s, lost it all when the bubble burst, made millions in real estate again in the mid-2000s, lost it all in 2008. I don't understand, he told me, and there were tears in his eyes. I'm not stupid. I know how to make money. I've proven that 3 times, but I can't keep it. Every time I build something, it disappears. What am I doing wrong? The answer was simple but painful. He was building fragilely. Every time he made money, he'd deploy it all. All in maximum exposure, no reserves, no insurance, no optionality. He was optimizing for the next good year, not for the inevitable bad year. He was building tall towers that couldn't withstand wind. You know how to create wealth, I told him, but you don't know how to structure it. You're a brilliant builder working without a foundation. And every time a storm comes, everything falls down. He asked me what he should have done differently. And I told him the same thing I'm telling you now. The same wisdom that could have saved him 3 fortunes. The same strategy that keeps the truly wealthy wealthy. Build as if you'll be wrong about everything. As if the worst case scenario will happen. As if chaos is not a possibility but a certainty. And then, when you've structured your wealth to survive that, then you can add the exposure that lets you benefit from the good times. In that order. Always in that order. Safety first. Not because you're scared, but because safety is what gives you the freedom to be aggressive when opportunities appear. The investor with no reserves, no ballast, no insurance. They can't take advantage of chaos. They're too busy trying to survive it. But the investor who's structured anti-fragility, they're shopping when everyone else is panicking. This is the pattern I've watched play out over 6 decades. The fragile get rich quick and poor quick. The anti-fragile get rich slowly and stay rich forever, not because they're more talented, but because they understand that wealth preservation is more important than wealth creation. That what you keep matters more than what you make. That structure trumps selection every single time. Think about it this way. Would you rather have the investment that makes you 30% when you're right, but costs you 50% when you're wrong, or the investment that makes you 15% when you're right and costs you 5% when you're wrong? Most people instinctively choose the first one because they plan to be right. They're confident. They're optimistic. But the anti-fragile investor chooses the second one because they know they'll be wrong, often. And the mathematics are clear. If you lose 50%, you need to make 100% just to get back to even. But if you lose 5%, you only need to make 5.3% to recover. The asymmetry matters. It matters more than almost anything else. This is why the wealthy stay wealthy across generations. They're not smarter than everyone else. They're not working harder. They're just structured differently. They've built anti-fragile systems that can survive anything, that can take hits and keep functioning, that can profit from the chaos that destroys others. And here's what most people don't understand. This isn't about pessimism. It's not about expecting disaster. It's about not needing to predict the future to succeed. It's about building a financial life that works regardless of what happens. That's not depressing. That's liberating. Because when you know your wealth can survive anything, when you've structured it to benefit from chaos rather than be destroyed by it, you stop living in fear. You stop checking prices compulsively. You stop lying awake at night worrying about what might happen. You've already prepared for what might happen, all of it. And that preparation, that creates a kind of peace that money itself can never buy. I learned this lesson in a way I'll never forget. It was the early 2000s, after the tech bubble had burst but before the housing bubble had fully inflated. I had a substantial position in a financial services company. Solid business, good management, reasonable valuation. Nothing flashy, just a good long-term holding. Then the rumors started. Accounting irregularities, potential fraud. The stock dropped 30% in a week. My friends called, concerned. My business partner suggested we sell before it got worse. The financial press was predicting the company would be the next Enron. The fear was palpable, and I did nothing. Not because I was frozen, not because I was in denial, but because I'd structured my portfolio anti-fragilely. This position, even if it went to zero, wouldn't materially damage my wealth. I had other positions that were uncorrelated. I had cash. I had bonds. I had diversification across time, across geography, across asset classes. I could afford to be wrong about this investment. So instead of panic, selling with the crowd, I asked myself the only question that mattered. Has anything changed about the fundamental business? And after careful analysis, I concluded it hadn't. The rumors were overblown. The accounting issues were minor. The market was overreacting, as markets do. I held on, and within 2 years the stock had recovered completely. Within 5 years it had tripled from the panic bottom. But here's what matters more than the profit. I was able to make a rational decision in the midst of irrational fear because I'd built my wealth anti-fragilely. The structure gave me the emotional capacity to think clearly. This is what people miss when they think about anti-fragility. They think it's just about surviving losses. But it's about so much more. It's about having the psychological freedom to make good decisions when everyone else is making terrible ones. It's about being able to buy when others must sell. It's about having options when others have none. Let me tell you about a concept that transformed how I think about building wealth. It's called optionality. And it's the secret weapon of the anti-fragile investor. Optionality means having choices, having multiple paths forward, having the ability to say yes to opportunities because you haven't locked yourself into rigid positions. Think about 2 investors, both with $1 million. The first investor takes that million and puts it all into one investment. Maybe it's a business, maybe it's real estate, maybe it's a concentrated stock portfolio. They're all in, fully committed. And if they're right, they might make extraordinary returns. But here's what they've lost: optionality. If a better opportunity comes along, they can't pursue it. If their investment turns out to be wrong, they can't easily exit. If an emergency arises, they have no reserves. They've traded flexibility for concentration. They've become fragile, even if they don't realize it yet. The second investor takes that million and structures it differently. Maybe $600,000 in diversified investments, $300,000 in cash and bonds, $100,000 in opportunistic capital that they can deploy when chances arise. Are they maximizing returns? No. Are they maximizing optionality? Absolutely. When the market crashes, investor 1 is stuck. They might be forced to sell at losses. They watch opportunities pass by because they have no dry powder. They're paralyzed by their own structure. But investor 2, they're alive. They're active. They're deploying that cash at the bottom. They're buying what investor 1 is being forced to sell. The structure has created advantage. I've lived both sides of this equation, dear friends. Early in my career, I was more like investor 1, concentrated, aggressive, fully invested. And I thought I was being smart. I thought I was being efficient with my capital. I thought holding cash was for people who didn't know what they were doing. Then I watched a close friend lose everything. Brilliant man, PhD in economics. He'd built a 7-figure portfolio through careful analysis and disciplined investing. But he'd built it fragilely. He was fully leveraged in real estate right before the market turned. When prices dropped, he couldn't service his debt. He was forced to sell at the worst possible time. His brilliance didn't save him. His structure destroyed him. That's when I understood. Intelligence is useless without proper structure. Analysis is meaningless without optionality. You can be right about everything and still lose if you're positioned fragilely. So I changed my entire approach. I started building for survival first and returns second. And paradoxically, my returns improved. Because here's what I discovered. When you're structured anti-fragilely, you make better decisions. You're not desperate. You're not forced. You can wait for the perfect pitch instead of swinging at everything. You can say no to mediocre opportunities because you don't need them. You can be patient because time is on your side, Warren. My dear friend and partner of 6 decades. He understood this intuitively. He always said that the first rule of investing is don't lose money. And the second rule is don't forget the first rule. People thought he was being cute, but he was being profound. Because if you don't lose money, you maintain your optionality. You stay in the game. You're there when opportunities arrive. But if you lose significantly, even once, you're starting over. You're climbing back out of a hole. You've lost time, lost capital, lost confidence. The mathematics of loss are brutal. If you lose 50%, you need 100% gain just to break even. You've given away half your optionality for nothing. This is why the anti-fragile investor obsesses over downside protection, not because they're pessimistic, but because they understand asymmetry. They understand that protecting the downside is how you create the freedom to capture the upside. It's not about being risk-averse. It's about being smart about which risks you take and how you structure them. Let me share a framework that's guided me for decades. I call it the Barbell strategy. It's simple but powerful. You put the majority of your wealth in extremely safe assets. Things that won't lose value in any reasonable scenario. Cash, treasury bonds, high-quality short-term instruments. This is your ballast, your foundation, your survival mechanism. Then you take a small portion, maybe 10 to 20%, and you put it in high-risk, high-reward opportunities. Concentrated positions in businesses you deeply understand. Venture-style investments. Things that could go to zero but could also multiply many times. This is your upside exposure. Your lottery tickets, if you will. What you avoid is the middle. The medium risk, medium return investments that most people fill their portfolios with, because these give you neither protection nor explosive upside. They're just mediocre, and mediocrity is its own form of fragility in a world of extremes. This structure is anti-fragile because you can't be hurt badly. The safe portion protects you from catastrophe, and you can benefit enormously if any of your high-risk bets pay off. You've created a symmetry. Limited downside, unlimited upside. And this is the mathematics of anti-fragility. I remember explaining this to a financial advisor years ago and watching his face contort with confusion. But that's not efficient, he said. You're leaving money on the table with all that cash. And those risky bets could easily go to zero. Why not just invest in a balanced portfolio of stocks and bonds? Because, I told him, your balanced portfolio is balanced for normal times. But we don't live in normal times. We live in a world of fat tails, of extreme events, of black swans that appear far more often than your models predict. Your balanced portfolio is optimized for a world that doesn't exist. My Barbell is optimized for the world as it actually is. He didn't understand. Most financial advisors don't. They're trained in modern portfolio theory, in efficient frontiers, in optimization, all of which assumes that the future will look like the past, that returns are normally distributed, that extreme events are rare. But anyone who's lived through multiple market cycles knows extreme events aren't rare, they're regular. And the portfolios that perform best aren't the optimized ones, they're the anti-fragile ones. Think about the 2008 financial crisis. The optimized portfolios, the ones with perfect asset allocation according to the textbooks, they lost 30, 40, 50%. The investors who'd been told they were diversified discovered they weren't. Because when everything is correlated in a crisis, diversification is an illusion. But the anti-fragile investors, the ones with massive cash positions and opportunistic capital, they had the time of their lives. They bought businesses at valuations not seen in decades. They deployed capital when everyone else was running away. They made fortunes not because they predicted the crisis, but because they were structured to benefit from it. This is the power of anti-fragility. You don't need to be right about what will happen. You just need to be positioned to benefit when something happens. And something always happens, dear friends. Always. I want to tell you about a young couple I met a few years ago, both in their early 30s, successful careers, no children yet, trying to figure out how to build wealth. They came to me with a common dilemma. They had some savings, maybe $50,000, and they wanted to know what to do with it. Their friends were buying rental properties with maximum leverage. Others were going all in on growth stocks. Others were day trading cryptocurrencies. Everyone seemed to be getting rich except them, and they felt paralyzed by indecision, afraid of missing out, afraid of making the wrong choice. I asked them a question. If you lost that $50,000 completely, how would it change your life? They thought about it. It would be devastating, they said. It took us 5 years to save that much. We'd be starting over. Then you have your answer. I told them. Any investment that could lose it all is too risky for you right now. Not because those investments are bad, but because you can't afford the downside. You're not structured anti-fragilely yet. I suggested they do something that seemed boring. Keep most of it in savings. Take maybe $5,000 or $10,000 and invest it in index funds. Just learn. Just get comfortable with markets. Don't try to hit home runs yet. Build the foundation first. structure for survival, then add risk. They were disappointed. They wanted the excitement, the big wins, the stories they could tell at parties. But I explained something that I hope you'll understand, beloved listeners. Boring is beautiful when you're building anti-fragility. Excitement is expensive. Drama is destructive. The foundation must be solid before you build the tower. 5 years later, they came back to see me. They'd followed the advice. They'd been boring. They'd saved consistently. They'd built their safe foundation. And now they had $300,000. And because they'd been patient, because they'd built anti-fragility, they now had the optionality to be aggressive. They'd survived the bull market without taking on too much risk. They'd survived the corrections without panic selling. They'd built slowly, steadily, boringly. And now they had choices. They could take meaningful positions in opportunities. They could survive being wrong. They could play offense because their defense was solid. Thank you, they told me. Our friends who leveraged into real estate lost everything when the market turned. Our friends who went all in on crypto are still trying to recover. We're boring, but we're wealthy, and we're sleeping well at night. This is the path, dear friends. Not the sexy one, not the one that makes for good dinner party stories, but the one that works, the one that compounds, the one that survives. Let me share another critical component of anti-fragility: redundancy. In engineering, redundancy means having backup systems. Multiple ways to accomplish the same goal. So if one system fails, others can take over. Most people view redundancy as inefficient, as waste. But in complex systems, redundancy is what keeps things running when the unexpected happens. Your wealth needs redundancy, multiple income streams, multiple asset classes, multiple strategies, multiple time horizons, multiple geographic exposures. Not because you need all of them to work, but because some of them will definitely fail, and you need the others to carry you through. I've always maintained at least 3 to 5 completely uncorrelated income streams. Not because I needed the money, but because I knew that any one of them could disappear at any time. Businesses fail. Investments underperform. Industries change. The world is unpredictable. Redundancy is insurance against that unpredictability. This seems wasteful when times are good. When one income stream is producing abundantly, maintaining the others feels like unnecessary work. But when that abundant stream dries up, and it will eventually, you're grateful for the redundancy. You're grateful you didn't optimize away your insurance. I watched a very successful executive learn this lesson painfully. He was making over $1 million a year at a tech company. His entire lifestyle was built around that income. His investments were modest because why save when you're making so much? His skills were specialized to his industry. He had no redundancy. Then his company was acquired. His position was eliminated. And at 55 years old, he discovered that his specialized skills weren't as valuable as he'd thought. Other companies wanted younger, cheaper versions of what he offered. His income went from 7 figures to 0 almost overnight, and he had no backup systems, no redundancy. He'd been fragile without realizing it. Contrast that with another person I knew. Made half as much but saved aggressively. Had rental properties generating passive income. Had a side consulting business. Had investments producing dividends. When he lost his job, he was disappointed but not desperate. His redundant systems kept him afloat while he figured out his next move. He was anti-fragile. This principle applies to every aspect of wealth building. Don't depend on one investment strategy. Don't depend on one asset class. Don't depend on one economic environment being permanent. Build redundancy into everything. Yes, it feels inefficient. Yes, you'll underperform when your primary systems are working perfectly. But you'll survive when they break. And survival is the ultimate competitive advantage. Here's another truth about anti-fragility that makes people uncomfortable. It requires you to think in decades, not years. Most people's time horizon is far too short. They think in quarterly returns, annual performance, 3-year track records. This short-term thinking breeds fragility because it forces you to care about short-term volatility. But if your time horizon is 20 or 30 years, short-term volatility becomes irrelevant. It becomes noise. It might even become opportunity. The market crash that terrifies the short-term trader is a buying opportunity for the long-term anti-fragile investor. The recession that destroys fragile businesses creates chances to acquire assets cheaply. I've never made an investment with a time horizon shorter than 5 years. Never. And most of my meaningful positions, I expected to hold for decades. This long-term orientation completely changes how you think about risk. What seems risky over 1 year might be very safe over 10 years. What seems safe over 1 year might be very risky over 10 years. Take cash, for example. Cash seems perfectly safe in the short term. No volatility, no possibility of loss. But over decades, cash is being steadily eroded by inflation. The safe choice is actually quite risky when your time horizon expands. This is why the anti-fragile investor holds some cash for optionality, but never holds too much. Because time is the enemy of cash, but the friend of quality assets. Or consider a wonderful business trading at a reasonable price. Over 1 year, the stock price might be volatile. It might go down. It might do nothing. But over 20 years, a truly wonderful business bought at a fair price will almost certainly create significant wealth. The short-term uncertainty becomes long-term near certainty. This is the magic of expanding your time horizon. But you can only think this way if you're structured anti-fragilely. If you're leveraged, you don't have 20 years. The debt comes due. If you're concentrated, you don't have the emotional fortitude to hold through volatility. If you're checking prices daily, you're training your nervous system to react to noise instead of signal. Anti-fragility gives you the gift of time. And time is the most powerful force in wealth building. More powerful than intelligence. More powerful than hard work. More powerful than luck. Because with enough time, compound interest performs miracles. Small advantages compound into massive ones. Good decisions compound into great outcomes. Patience compounds into wisdom. I think about a decision I made 40 years ago. I bought shares in a consumer products company. Nothing exciting. They made everyday items that people bought consistently. The growth was modest, maybe 5 to 8% a year. The dividend was nice, but not extraordinary. Wall Street largely ignored it because it was boring. Over the years, that investment has returned over 100 times my initial investment. Not from any dramatic events. Not from brilliant trading. From boring, consistent, compounding growth over 4 decades. From the anti-fragile structure that let me hold it through multiple recessions, market crashes, and periods when it underperformed. From the time horizon that measured success in decades, not quarters. Could I have made more in some high-flying tech stock? Maybe, for a while. But would I have had the conviction to hold through the inevitable volatility? Would I have survived the crashes? Would I have avoided the temptation to sell and chase the next hot thing? Probably not. The anti-fragile position in a boring, stable business that I could hold, that I could trust, that I could wait for. This is the paradox of anti-fragility. By accepting lower potential returns, by building boring structures, by being patient, you often end up with better actual returns. Because you stay in the game, you don't get shaken out. You don't make emotional mistakes. You let time work its magic. And the peace that comes with this approach, the freedom from anxiety, from comparison, from the constant pressure to do something, that's worth more than any return. Because what's the point of wealth if you're miserable acquiring it? What's the point of being rich if you're constantly terrified of losing it? Anti-fragility gives you both, the wealth and the peace, the returns and the sleep, the growth and the security, not by being perfect, not by predicting the future, but by being structured correctly, by understanding that how you hold your wealth matters more than what wealth you hold. Let me tell you one more story before we go deeper into the practical implementation. This one is about a mistake I made, because anti-fragility doesn't mean you never make errors. It means your errors don't destroy you. In the early 2000s, I invested in what seemed like a wonderful retail business, strong brand, good management, decent economics. I did my analysis. I bought at what seemed like a fair price. And then the world changed. E-commerce emerged faster than anyone expected. Consumer behavior shifted. The mode I thought existed evaporated. The investment was a failure. I lost about 40% of the capital I'd deployed. It hurt, not financially. I'd structured it anti-fragilely so the loss was manageable. But it hurt my ego, my self-image as someone who makes good decisions, my belief that I could identify durable competitive advantages. But here's what anti-fragility gave me. The loss didn't cascade. It didn't force me to sell other positions. It didn't prevent me from taking advantage of other opportunities. It was contained. And that containment, that allowed me to learn from it without being destroyed by it. I studied what went wrong. I updated my understanding of how technology disrupts retail. I improved my analysis of competitive moats in a digital age. And those lessons, those paid for themselves many times over in subsequent decades. The mistake made me better, but only because I'd been structured to survive it. This is what anti-fragility allows. It allows you to take risks, to make mistakes, to be wrong, because the structure ensures that being wrong isn't catastrophic. And when being wrong isn't catastrophic, you can learn from it, you can adapt, you can get better. The fragile investor can't afford to be wrong, so they never truly learn. The anti-fragile investor can afford mistakes, so they grow from them. And that growth, that continuous improvement, that's the real compounding. Not just the money, but the wisdom. Not just the returns, but the understanding. Not just the wealth, but the character. This is the strategy that keeps you rich forever. Not just rich in dollars, but rich in capability, in resilience, in peace.